The U.S. stock market currently navigates a landscape of rising national debt and volatile financial indicators. It is an environment heavily primed for friction. To understand how this market sustains itself despite these risks, we look to Soros's theory of reflexivity. This principle suggests that investor biases do not merely reflect the economy, they actively alter its underlying structure. When enough traders believe the market is too big to fail, their continuous buying creates an overvaluation loop. The market stays elevated because participants expect it to stay elevated, regardless of traditional metrics. This reflexive behavior transforms high valuations into a self-fulfilling prophecy. Prices remain high because buyers keep stepping in, reinforcing the collective belief that the system is invincible. This prolonged detachment from actual value has a severe side effect. It turns the financial ecosystem into a digital powder keg, sensitive to any sudden disruption. A disruption often arrives through direct communication. A U.S. president steps to a podium or posts on social media using aggressive rhetoric regarding trade, or outlining potential sanctions and intervention in the Middle East. The average citizen reads this message as breaking news. Under the surface, however, the text instantly transmits across fiber optic networks, acting as a direct command to the financial sector's infrastructure. That single string of text acts as the spark. It initiates a rapid timeline where high-speed machines and emotional human traders diverge in their reactions. At millisecond 1, AI trading bots intercept the message. These algorithms utilize natural language processing, a branch of AI that allows computers to interpret and categorize human language, to scan the statement for specific data points. As historical keywords like sanctions or intervention are identified, high-frequency trading bots execute mass sell-offs in a fraction of a second. By minute 10, a secondary wave of algorithms joins the momentum. These bots use nowcasting to anticipate broader economic movements before official reports. Anticipating a broader market retreat, these nowcasting programs intentionally short the market. They bet against current prices to harvest the sudden volatility, accelerating the downward spiral. The algorithms engineer a flash crash before a human trader has even processed the end of the original social media post. By hour 1, human traders scramble to respond. Facing sudden, steep losses, they succumb to emotional contagion, absorbing the fear and aggression embedded in the original political message. Their judgment is clouded by vividness bias. Risk is the psychological tendency to give far more weight to terrifying, highly visible events, like military convoys and explosions, than to abstract, long-term economic data. By hour 3, the crash is fully visible on the screens. Watching the red numbers multiply, human participants engage in herding behavior, following the crowd toward the exit out of fear. Retail traders watch the market drop and assume the large institutional funds possess hidden knowledge. This triggers severe loss aversion, leading them to dump their positions at a steep loss. This panic selling at the market bottom is exactly what the algorithmic loop is designed to exploit and purchase at a discount. The modern stock market reflects the digital perception of reality. Prices move based on how an event is interpreted by the network, rather than the physical reality of the event itself. Navigating this requires distinguishing between high-profile political posturing and the specific developments that shift a company's actual balance sheet. Relying on inverted reasoning, the assumption that the most obvious takeaway from a news alert provides a hidden edge, often leads to the wrong conclusion. In truth, large-scale geopolitical expectations are often priced into asset valuations weeks or months before a politician's social media post ever goes live. Filtering out the social media cacophony removes the impulse to react instantly. When you stop trying to beat the machine to the exit, their millisecond execution loses its power over your portfolio. Breaking the herding habit requires ignoring the theoretical movements of the smart money. Trying to guess what institutional giants are doing based on sudden price drops leads to poor timing. Effectiveness comes from sticking to a predetermined long-term trading thesis. A well-researched strategy should not be abandoned because a push notification flashes across a screen. When financial chaos threatens long-term value, the strategy shifts toward seeking traditional safe havens like gold rather than liquidating assets in a panic. Traders must recognize that a sudden spike in heart rate from a news alert is a manufactured trigger designed to draw them into the algorithmic loop. Surviving the digital age of investing requires discipline. Humans must unplug from the emotional noise, trust fundamental data, and refuse to play a high-speed game they were never built to win.